talk today about risk management. So this is going to be a capsule session. I've tried to bring in everything that's relevant, that's important, even from exam point of view, those who are also appearing from not just internal examinations, but things like CAIIB. I'm trying to bring in everything in this one go. So the learning objectives for today's session would be, we'll talk about what is risk, what are the various types of risk, what is the process of risk management. We will deep dive into what's capital adequacy, what is CRAR, Basel III 1 to 3. So we're going to talk about Basel overview, and lastly we're going to talk about credit ratings and risk weightage. So a very important quote here: all of life is a management of risk and not its elimination. So we all know that it's not possible for us to eliminate risk 100% from our lives, and that's what we do in day-to-day life also. So we're trying to manage risk at best. So on this note, let's begin with today's session. So let's understand first the concept of risk. So when we talk about risk, the first connotation that we have in mind is there's some harm or some hazard. There's something negative that's going on that's going to harm me. So let's say I go out and I want to take a car out and drive. So there is a harm, there's a hazard that I may meet with an accident. Then there's some kind of uncertainty or some kind of possibility. Now we don't know, it may happen, so it may or it may not happen, right? So there is, I'm sorry for the pen tab today. So there is some kind of uncertainty which it may or may not happen, right? It's not certain that this particular event which will cause me harm or hazard will happen. Then there's always an adverse outcome or a loss to it. So anything which is adverse, something that happens better than our expectation, isn't risk. Something that is worse off, that puts us in a worse off situation, is what is risk. It always talks about the future. Why? Because the past is known, the present is known. We can't do about anything about the past. The present is known. We are talking about future. That is what is uncertain. And because it is uncertain, there is a chance, there is a possibility that there may be a risk of loss. And of course, there's a variance between expected and actual return. So there is some benchmark, what I thought will happen and what actually happened. When there is a variance between the two, and this variance being negative, then we're talking about risk. For example, I decide to set up a business, right? Now, it's the first year of business, and I presume that I'm going to have a loss of 1 lakh rupees, right? Now, it can be a scenario where I do have a loss of 1 lakh rupees. So my expected and actual return, whatever I thought, matches. So no risk. But what if I have a loss of only 50,000 rupees? Will that be a risk? I expected 1 lakh loss in the very first year, probably break even by the 5th year. My loss was only 50,000. So that's not really a risk for me, because I thought that, okay, in the first year I'll have at least 1 lakh. So it's okay. But if I, for example, incur a loss of 2 lakh rupees, now there is a variance, and this variance is negative, right? So there is an adverse variance, and here we talk about something called risk, right? So just to bring all of that together, what is risk? Risk is a chance as in possibility of loss, a possibility of some adverse occurrence in future. Uncertainties resulting in adverse outcomes, and very important, adverse in relation to what? To our planned objectives or planned expectations. I thought this actually happened. Therefore, I'm talking about something risky happening. I expected the market to go up. I expected my stock price, my investment value to go up. The stock market crashed and I suffered a loss. There is a risk, right? So whenever what we expect and what actually happens, there's an adverse thing that's happening, that is risk. So just to sum up again, risk stems from uncertainty or unpredictability of future. Volatility. So there's not a steady income. Volatility in my potential or expected income or cash flows, right? So for example, let's say we are all bankers and we get a fixed salary of, let's say, 50,000 per month. Now, every month, I know that I'm going to get 50,000 per month. And accordingly, I will plan out my expenses for the month. But let's say I'm a businessman or I'm a hotel owner in Shimla. Now it's a COVID situation. So there could be few months where I have a 1 lakh per month income. There could be few months where I have a nil income. There could be some months where I have a 20,000 income, right? So what is happening here? There is a volatility. It is unsteady, right? It is not something which is steady income. So because there is a volatility in my expected or potential cash flows, therefore there is a risk. Low risk implies low variability in my cash flows and low upside or downside potential, right? So it can be both upside and it can be both downside potential. So upside, if it happens, well enough, I'm pretty happy. But downside, if it happens, sad for me, right? High risk implies higher variability in my cash flows, higher upside or downside potential. On the other hand, zero risk means no variability in my cash flows. Now, practically speaking, there is no such thing as a zero risk, because even if we invest in FDs where we have a fixed rate of return on government bond, there is an element of inflation that will come into play. So our real returns, for that matter, yeah, will get impacted, right? So if I were to say zero risk is a ideal situation, but that really does not happen. Last but not the least is risk involves a choice and the uncertainty that the choice or a decision entails. So there's always a choice attached to it. So I had two options. Let us say I, probably wanted to continue in a job, or I had a wanted to go for a startup. So there was always an option. Because I had an option, something to do with future, and there was an uncertainty attached to what if it doesn't work out the way I expect. Therefore there is a risk. There's always a choice between two things that you had, and there's an opportunity cost attached to it, which something you forego, right? So this is what is the concept of risk. Now let's understand, in banks, how does risk come into play? So a small illustration. So let's say we have ABC Bank, accept deposits from the public. Two ways it uses it. One, it gives out loans and advances. Number two, it may invest. So 100% of the deposits that come, it will not give out 100% into loans and advances. A part of it is investment in the market instruments, yeah, or your SLR, CRR securities. So deposits become our liabilities, loans becomes our assets. And now let's say what happens is a large number of depositors start withdrawing money. So let's say there's a new bank, let's say RBL bank comes into play, and on its savings bank, it offers 7% interest rate, right? Just assuming hypothetical situation. So all the depositors, especially the wholesale depositors, the bigger ones, the corporate houses, so all those who are depositing their money in ABC Bank will start withdrawing the money from here and going to RBL Bank, right? Or there can be a situation where, let's say, there is something like a negative news about a bank, right? Some negative news about the bank, and the people panic and they start withdrawing their deposits from here and going and putting their money outside. So there's some negative news about ABC Bank, right? Now when depositors come and ask for the money, the bank cannot refuse. Now these are called unanticipated, unexpected, sudden run off the bank. So the another term which is often used is run off on the bank. Please remember this term, run off on the bank or run on the bank. Run on the bank means sudden unanticipated withdrawal of deposits which the bank did not expect, and that is a large sudden unanticipated deposit, not somebody coming up and withdrawing, let's say 5 lakh or something. So a major portion of your deposits are being withdrawn, so that is known as your run off on the bank. On the other hand, what if, so we have given out loans and advances. Now let us say I gave loans and advances to Indigo. Another word for Indigo is your Indigo Globe Aviation. That's the company name. I gave funds to the airline industry. You know the COVID situation. So airlines are really suffering. They are having a lot of losses because there's a problem with the travel industry, tourism. So the airlines are the real sufferers here. Or let's say I lent a significant portion of my loans to real estate industry. Now the customers in these industries start defaulting. So here, the money which was to come did not come, right? So because there was a significant default of major customers, major chunk of my loans, they've started defaulting. The money that was to be repaid on certain due dates has stopped coming. So my income stops coming. Here I have a lot many depositors standing on the door of my bank asking their deposit back. Premature withdrawal of FD or taking away their current account savings, any kind of deposits. So on one hand, I have to make some cash flows there. On the other hand, the money which was supposed to come in stopped coming. Third, what if bank has invested in some kind of stocks like tourism or real estate, which again there's a fall in the market value. Because there's a fall in the market value, there's a stock market crash or something, value of my investments. So my investments were to fetch certain value. This did not fetch that kind of value. So value of my investments declined, right? So if I need to sum up in three simple words, what is this ABC bank facing today? On the loans and advances, credit risk. On the market instruments, market risk. And here, the cash flows which were supposed to come in did not come. The cash outflows are there, higher. So the ABC bank is facing something called a cash crunch, right? And that, in simple words, in parlance of risk management, is called liquidity risk. So this is what, in short, is about risk in the banks. So now we'll discuss. So risk is an internal part of the banking sector, and due to the uncertainty and unpredictability of the financial markets, banks face risk, which may cause losses or reduced income. We'll now deep dive into each one of these risks. So if I need to classify risks, okay, broadly speaking, there are financial risk and there are non-financial risk. Now, both financial and non-financial risks do have an impact on the bottom line of the bank or on the profitability of the bank, right? But the source from where this risk is coming from, that may be either financial source or they could be non-financial source. Now it's not a very clear-cut classification. So some people take operational risk also as a financial risk. So it depends, but primarily credit risk, market risk, liquidity risk are called your financial risk. Whereas operational risk, any kind of legal compliance risk, reputational risk, or strategic risk, they are known as non-financial risk. And so financial risk, every bank is very, very careful about, right? But between 2011 and 2017, the total amount of non-financial risk losses amounted to almost euro 500 billion. So yes, so that is something that is equally important, the non-financial risk, because the downside there is pretty large. Now, within financial risk, the first and the foremost is your credit risk. So we all know, we're all bankers, that 60% of a bank's balance sheet is made up of our loans and advances. Pick up any balance sheet, it will be between 50 to 70%, right? So because almost 50 to 70% of our bank's balance sheet is made up of loans and advances, so the biggest risk that the banks face is credit risk. And this was something that we'll read later, was the first risk that Basel addressed. All other risks came later. So credit risk, everybody identified and everybody recognized, yes, it's a huge risk, and therefore it was addressed ab initio, right? Now, what is credit risk? It is the possibility of loss. Possibility kyun? Because it may happen or it may not happen. Zaruri nahi hai, it will happen. Of loss resulting from borrower's failure to repay a loan or to meet its contractual obligations, right? So two very important aspect is, the loan has to be paid in full and it should be timely payment, right? Full and timely. There is a risk of default on a debt, right? So after taking a loan from the bank, the customer may fail to repay. And this probability of loss arises from a credit transaction. Now, how do we measure credit risk? So two ways to measure credit risk. One is your credit rating. So usually banks rely upon external credit ratings. The second, that is ECA. The other is your ratios, certain ratios on asset quality. Now, before I move further on to what exactly this is, credit ratings measure the credit worthiness of a borrower. So whether it's a Malia, whether it's a Nirav Modi, everybody has been rated. And what are we checking there? Whatever banks want at the end of the day is whatever money I have lent comes back to me in full and timely, on time, right? So credit worthiness, when I say the word credit worthiness, what rating agencies or we bankers mean by that are two things: the ability plus the willingness to pay the debt. Ability to pay, kshamata honi chahiye, and willingness, whether he is willing to pay that debt or not. So one, that maybe that his business, when I lent, the business was doing well because of, let's say, COVID situation, the business is shut down, so he does not have the ability to pay the debt now because there have been losses. One is this. The second is he has the ability, he has the money, but the willingness is not there. When the willingness is not there, we classify the borrower as a willful defaulter. Now, in case of Malia, Vijay Malia, this was one of the major things that says he's been identified as a willful defaulter because he said that his personal wealth was not attached. He was still living a life of luxury, and yet he was not paying salaries to his employees. He's defaulted to the banks, and people, banks could not attach the properties. There was no collateral property per se. They were just defunct things, some helicopters and all, which were taken as a collateral property, and so on and so forth. So what credit ratings measure? They are measuring the ability and the willingness or the credit worthiness of the borrower. So if there's a downgrade in this rating, which means the credit worthiness of the borrower has declined. Now, credit risk is also measured via ratios. So the most popular ratios, if we ever study and we talk about, is gross NPA ratio and net NPA ratio, right? Also, what banks do is they set up guardrails. So they are setting up guardrails. What are guardrails? So they'll always talk about concentration risk. A lot of bad banks or bad banks that has happened, or a lot of bank failures that have happened, is because a significant portion of the loans and advances were given to a particular group, a particular borrower, a particular industry. So now every bank and the credit policy clearly defines guardrails that, okay, for maximum single person borrower limit should not exceed 10% of total advances. Maximum group exposure limit should not exceed 20% of the total exposure. Maximum in the industry exposure, so let's say iron and steel, should not be this much. To real estate, to infrastructure, should not be this much, and so on and so forth. Also, in terms of rating, you will not give incremental exposures to accounts rated double B and below, right? Or maximum exposure to triple B and below should be this much, right? So what are the banks setting? They are setting some guardrails. A lot, many times have been seen, like, for example, Malvinder Shivinder case, where significant proportion, a small bank has given a significant portion of their loans and advances to one particular group of borrowers or a single borrower, right? And that has led to the define or the default. Now, the second one is your market risk or the systematic risk or the price risk. Now, what is market risk? Market risk, another type of financial risk. It is the potential loss on the financial investments due to adverse price movements of any of the market instruments. Now, what could be the various market instruments? It could be interest rate, it could be currency, it could be stock price, any investment that the bank has made, equity price risk, or commodity. Now, banks are not allowed to trade in commodities, so commodity price risk does not come into play. So any risk of losses in on or off balance sheet. So every bank, just like in any company, has on balance sheet items and some off balance sheet items, right? For LCs and BGs that a bank may have issued on behalf of the client or the borrower. So risk of losses in on and off balance sheet risk positions arising from movements in the market prices lead to market risk. The sources could be investments in commercial paper, corporate bonds, government securities, any open forex positions. It can also lead to your market risk. So what RBI does is RBI sets limits. Maximum open forex position should not exceed so and so forth. So that is what RBI says. Why? To limit the forex losses. So now this kind of market risk, it's called systematic risk, also called the price risk, because it impacts the entire market, right? So it's not a particular class of stocks or investments, it will impact the entire market class. So it is beyond the factors beyond our control. And that is why it is called systematic risk, right? Now, within market risk, we have interest rate risk. So what is interest rate risk? So any change in the value of the asset or a liability, which is interest bearing. So rate sensitive assets and rate sensitive liability. So for example, current account. No interest is paid on current account. It is not a rate sensitive liability, right? Or for example, fixed assets in the bank's balance sheet. It's not rate sensitive. So any asset or a liability which is interest bearing, which is rate sensitive, wherever there's a change in the interest rates, if there is an adverse impact on our NII or an adverse impact on the value of the assets and the liabilities, then it is known as your interest rate risk. Now, how do we measure interest rate risk? There's something called traditional gap analysis and traditional duration analysis. Now, we'll not deep dive into these two because that's going to be again another session. But just to understand what banks does, so interest rate risk, one, it impacts clearly your NII. So on the profit and loss aspect, P&L account, it impacts your net interest income. And on the balance sheet, it impacts your market value of equity, which is nothing but the net worth of the bank. And net worth is nothing but present value of your assets, again rate sensitive assets, minus the present value of your liabilities. So assets minus liabilities, whenever there is a change in the interest rates, it will hit your net interest income, one, and second, it will hit the value of your assets and liabilities or your net worth, right? So whenever we talk about interest rate risk, because there have been fluctuations, the inflows and the outflows get impacted. An example of this we can just say, so for example, let us say that we have rate sensitive assets and we have rate sensitive liabilities here. Now, so let us say that one of the interest rates increase, right? Now there is a rate sensitive assets are more than my rate sensitive liabilities. So let us say I am earning 10%. I have 100 crores, let's say, deposits, and 100 crores deposits have been invested to give out 100 crores of loan. These loans are, let's say, at fixed rate of interest. So it is at 10%, right? However, these liabilities are on a floating rate of interest, and I was probably giving out something like a 8% on my deposits. So the NII of the bank is what? 10% minus 8%, 2%. Now, assuming that the interest rates increase by say 1%. Now, my 100 crores of loans were at fixed rate of interest, so I continue earning 10%. But my liabilities, 100 crores of liabilities were on fluctuating or floating. So the interest rate increases by 1%, it will now be 9%. So when earlier I was having an NII of 2%, my NII declines to 1% by a 1% increase in my interest rate. So I hope interest rate risk is clear. How does it impact bank? Two ways. It impacts the NII, and number two, it impacts the market value of the equity or the net worth through changes in the value of the assets and the liabilities. Commodity risk, banks are not allowed to trade in commodity, so that is not getting impacted. Forex risk. So there is a possibility of losing money through unfavorable movement in the exchange rates, right? And the source of this is the open positions or the counterparty risk which is there. So RBI mandates a maximum open position limit, right? So whenever there's a financial transaction denominated in currency other than the domestic currency of the company, then there will be a forex risk there. Next, there is an equity price risk. Now, these are all parts of market risk, right, friends? They're all parts of your market risk. What is equity price risk? So, banks do invest in equity shares or some kind of investments that they have, and that's held in the trading book of the bank, right? So, whenever there's a fluctuation in the stock price, it will impact the value of the investment. So, this is your equity price risk. Now, another thing is your liquidity risk. Whenever we talk about liquidity, we all can relate to it because we all face something called cash crunch. So whenever there's an inflow outflow mismatch, there will be a liquidity risk. So risk arising from funding of long-term assets by short-term liabilities, that is deposits, right? Either they're due sooner or full repayment or realization of the assets. This asset liability mismatch, ALM, is what is my liquidity risk. So whether it is like, for example, NBFCs, so they were borrowing on the short term. So from the money market, from the mutual fund, the NBFCs were borrowing and they were lending to infrastructure projects on the long term. And they were rolling over their short term liabilities. So there came a point of time where they suffered the asset liability mismatch, and that was what was your liquidity risk. So inability to bring in requisite cash inflows to meet your cash outflows or obligations, right? So either your assets become untradeable, they cannot be converted into cash, or your borrowers default, so the money does not come in, or unexpected outflows, so there are large unexpected withdrawals, right? Any of your bank guarantees that you have issued that has actually been crystallized, invoked, right? So any kind of cash crunch leads to my liquidity risk. Now liquidity risk is primarily of three types: one, funding risk; two, call risk; three, time risk. What is funding? Non-funding of financial obligations or unanticipated withdrawals. Something we said was a run off on the bank, run on the bank, or the run on the bank. So suddenly, unanticipated huge withdrawal of my deposits, or my FD was for 5 years, and the customer says after 1 year that I want to premature withdraw my FD. This is funding risk, right? So suddenly you had a liability of FD that you were supposed to pay, let's say 10 crores FD was there. You were thinking that iska due date will be after 5 years. The customer comes and asks me, today I want the money back. So now I have to pay that 10 crores. I don't have the money to pay those 10 crores. I thought it will come after 5 years. Funding risk. What is call risk? Crystallized contingent liability. So any of my LC or bank guarantee, these are contingent. They are not actual liability. They will be due on the happening of certain events. So for example, a BG of 5 crores gets invoked, right? LC gets devolved, right? So it becomes an actual liability. Now bank was not expecting such a thing to happen, but now I have to pay 5 crores from somewhere. Call risk. What is time risk? Risk of non-payment of contractual obligations or non-receipt of my inflows on the due date of loan. So if some big amount becomes an NPA, right? And the money that I was expecting it will come in on such and such due date, it does not come, and I have liability standing to pay, it will be time risk. Next is your operational risk. So now we come to non-financial risk, right? So first one and very important is your operational risk. So some point of time this was never discussed. It was in Basel II that the first time people thought about talking, about operational risk. What is operational risk? Possibility of loss resulting from inadequate or failed what? Processes, people, systems, or external events. Four things. Process. There's some issue with the process. So maker checker process is not there, right? People. So there is internal, external fraud. Systems. There's a power failure. There is a virus attack, any kind of system failure, or there is no electricity in the branch for many hours, or some external event like a earthquake, a fire, a vandalism, any kind of thing. Anything that occurs in my day-to-day operational activity, right? Cyber security fraud, third party risk, internal fraud, business disruption. So as per Basel, operational risk includes your legal risk but excludes your reputational or strategic risk. This is as per the Basel definition. Now a lot of times in the exam this is asked. There's no logic to why Basel has excluded these two risks, but a lot of times it is asked what is excluded of operational risk. So reputational risk and strategic risk is excluded from operational risk. Now one of the biggest examples of my operational risk is my Nirav Modi Punjab National Bank fraud. So it was a case of operational risk where the LOU that was issued was not routed through the core banking system, right? Where the person who was to be transferred every 5 years was not transferred. So there was a failure as far as the operational risk was concerned. So, actually, as per Basel, there are about 8 business lines that are identified, and 8 reasons or events that are identified, sorry, 7 loss events and 8 business lines that are identified which can cause operational risk. So now banks are very, very much involved in what is operational risk, how to measure operational risk, and how to mitigate this operational risk. So what are other non-financial risks? We have something called reputational risk, which is possible damage to the reputation. We have compliance legal risk, where there's non-compliance with the laws, the rules and regulations, any kind of ethical standards, any kind of non-compliance to that. Strategic risk. Strategic matlab bank has had a business strategy. I am going to expand in my branches in the rural areas. That strategy fails. And because of that, the bank faces some loss. So whenever there is a business strategy that fails, right? So that may lead to strategic risk. Technological risk to some extent is a part of the operational risk, some kind of failed technical system, cyber security, frauds. Now, another very important risk is systemic risk. This is not to be confused with systematic risk. This is systemic risk. What is systemic risk? So, another word it is called as ripple effect, domino effect. Yeah, if I talk about COVID, another word, I don't know how many of you have seen this movie called Contagion. Contagion effect, which spreads very fast. Why it spreads very fast in the financial sector, this is so very inherent, is the interdependence, right? So banks are not working in silos. So whenever there was a 2007-8 global financial crisis, banks were not working in silos. So something happened in US, impacted Europe, and so forth, right? So what is systemic risk? It is the failure of collapse of the entire banking system, right? And why does it happen? Because of high inter-bank relations. So a major bank being in trouble, more banks being in trouble, they have lent to each other. So banks have lent to NBFCs, NBFCs borrowed money from us. We have mutual funds. So all of this is interdependent. My borrower has taken loans from several banks. So if my borrower defaults, many other banks will be in the same. So what is happening? This is called systemic risk, right? Domino effect or ripple effect. Like we've seen in toys, one falls, the rest of them falls. Now, we've understood what are the various or the major risks that banks face, financial and non-financial. So why risk management? Some names, and there must be something common in these names. Can you guess what is common in these names? Yeah, Yes Bank, PMC, DHFL, Lakshmi Vilas, ILFS. So banks or financial institutions for that matter. So they're all bad banks. They've been, cause of bank failures. So this is exactly why we need risk management today. And we have so much thrust on risk management. Risk management ensures that the banks remain solvent and financially stable. Ensuring adequacy of capital availability and loss potential can be controlled to ensure business continuity. Banks are too big to fail. Banks should not fail. So today you have a concept called systemically important banks, SIB. 3 banks, SBI, ICICI, and HDFC have been identified as systemically important banks. That is, they're too big to fail banks. So whatever are the Basel norms for the rest of the commercial banks, for these 3 banks, there'll be some more stringent norms because banks are not supposed to fail. Why? Because they are dealing with public money. So for this, we need to know where is the risk, how much is the risk, and how to manage the risk. How much capital I need. Why we need capital? That is a cushion for absorbing my losses. There is a loss absorption capacity of the capital. So how much capital should I need to absorb my losses? Well-managed banks can help banks attain higher returns, minimize the chances of loss, and avoid bankruptcy. So banks are dealing with public money, and the consumer confidence is the key aspect. So 2 very, very important things that RBI talks out away is PCA and SIBs. Prompt corrective action. So he said, forget, it's not that everything happens and then RBI steps in. You have to be early intervention, timely intervention. You have to step in at the right time and prevent the bank to get into ICU stage. And there should be something called systemically important banks. So 3 domestic systemically important banks were identified. They were too big to fail. So these are the two things which are there, which are a part of my risk management thing which RBI came up with. Now, what is the process of risk management? So we know what are risks, we know why it is needed. So what is the process? Simple. पहले देखना है कहाँ है risk. When you want to solve a problem, you need to identify it first. Where is the risk? Once you identify, you analyze and assess the risk. कितना है, कितना ज़्यादा है. Third, you find out ways to mitigate the risk, and last, you need to monitor and control. So whatever were my strategies. So identifying means ascertaining the cause of risk, the source of the problem, what events caused it. Was it an internal event, fraud, unauthorized access, or was it an external event, a pandemic, a theft, a lost fire, or something? Once I know the cause, I need to find out what are the, how to analyze it or how to assess it. So when I talk about analyzing and assessing, we're talking about the probability of default, or what are the chances of that particular event happening, and the severity given the default. For example, I say in my branch, there are frauds that are happening. Now, the probability of fraud happening is, let's say, once a year, once a month, or once in 6 months. This is my probability of default, right? The chance of that event, that fraud happening is once a month, once a year, or once in 6 months. Now, I know the event. Let's say it happens. What is the severity? What will be my impact? So let's say one fraud, its impact is 50,000 rupees, or is it 5 lakh rupees, or is it 50 crores rupees? That is a severity. So based on this particular thing, what I need to decide, I need to understand what will be my risk mitigation strategies. So based on this high probability, high severity, I'll have a different strategy. A low probability, a low severity, I'll have a different strategy. So I make a grid, and based on that, I decide my risk mitigation strategy. What I can do, like my 4 aspects in this process, there are only 4 risk mitigation strategies. Either I can accept the risk. When I can accept the risk, it's too small, there's low probability of it happening, and there is a low severity. हो भी जाएगा तो बहुत ज्यादा नुकसान नहीं होगा. ठीक है, जब होगा तब देखेंगे. So that's accepting. Second, I can avoid the risk. Too high a probability of it's happening, and too huge a loss. Jammu and Kashmir में terrorist attack होने के chances हैं, and I open a branch there suddenly, and it's quite sure that there's going to be a terrorist attack there. So I may just avoid that situation. I may not open the branch. Let's assume. So too much a risk to take, I avoid the risk. Or I can control or reduce the risk. So I know this risk is going to happen. I have a double maker checker there. Or I may take some extra security. If I know this loan is risky, I may take some extra security, some extra precaution. So I'm reducing the risk. The fourth way to mitigate is to share, transfer, or outsource. So for example, recovery thing. Now given my staff, I cannot recover loans, so I outsource it. ATM, I outsource it. So I'm giving it to somebody. Or I share it, transfer it, I insure. For example, my branch, my house, what do? So there may be a loss of fire or something happening. I insure, I take an insurance for my house. I take a burglary insurance. I take a fire insurance. I take a life insurance. What am I doing? I'm transferring risk. So the risk mitigation strategies are 4. Either you accept, avoid, control, or share. Based on what? What is the probability of that happening? And if it happens, what is the impact? Based on this grid, I will decide upon any of the strategies or both of the strategies. Once a decision has been made, I need to monitor. I need to report it. If there are exceptions, I need to report it to as per the hierarchy laid down. So this is all about risk. Any doubts still here? Okay, so thank you so much. So now we move to something called capital adequacy, right? Now, this is a statement. I wanted to bring this to you. RBL Bank was in news recently. This is a statement of RBL Bank that has been issued by the Reserve Bank of India. Now, just want to read through it. The RBI would like to state the bank is well capitalized. Financial position of the bank remains satisfactory. They have a comfortable capital adequacy ratio of 16.33%. Provision coverage ratio of 76.6%, liquidity coverage ratio of 153% as of December 21. right? So there were some additional directors which were appointed. The key person has gone on immediate leave there, and RBI has also appointed one of the directors. So there was a lot of frenzy in the public. So this is a statement that has been released by the Reserve Bank of India. I'm going to discuss what these points are. What is capital adequacy? What is liquidity coverage ratio? What do you mean by the bank being well capitalized, right? So what is capital adequacy? Simple. We having adequate capital. Okay. Why capital? Why do we need capital? Right. So there are two ways. You can source funds by capital or debt. Right. Now, if there is a loss, if a borrower defaults, if a Kingfisher or Malia defaults, now debt is in for banks are your depositors. You can't say Malia has defaulted, I'm not going to pay my depositors. You have to pay your depositors, right? That's debt. That is something you owe. So what is bank going to do? How is going to meet the loss from that NPA? Through my capital. So capital is my loss absorption way. So it is expressed as the ratio of bank's capital to assets. So we take out something called capital adequacy ratio. My capital divided by my risk weighted assets. When I say capital, it is divided into tier 1 and tier 2 capital. So just like in any other institution, manufacturing company, we talk about solvency ratios. We did that in ratio analysis. So here also, measuring the financial strength of the company, we have something called the capital adequacy ratio. Or if it was for RBL, if it was 17-19%, so that is the financial strength of the company. That indicates the financial strength of the company. How much capital a bank has is in percentage to its risk-weighted assets. It is also known as Cook ratio, right? It's a measure of credit risk, right? And a low ratio indicates the bank does not have enough capital for the risk associated with the assets. It can go bust anytime. So higher the capital adequacy, the better it is. Now, this does not include just credit risk today. After Basel, so this will be also operational and market risk. We'll come to it later, right? A very high ratio also indicates that bank is not utilizing its capital optimally. So you're not trading on equity. Agar aap Sara, for example, I give 100 crores of loans in advances, and entire 100 crores of loans I funded through 100 crores of my own capital. Is it prudent? I have a huge capital adequacy ratio, but is it prudent? No. So there must be some element of debt, right? I shouldn't be putting the entire money because there's always a cost attached to it, right? So a low ratio is also not good because in any which ways the bank can go bust if there is any big failure that's happening. But a very high ratio is also not good. So Basel has a 9% capital adequacy ratio. So now under Basel, we have risk-weighted assets. When we talk about risk-weighted assets, we talk about credit risk plus your market risk plus your operational risk-weighted assets. So based on this risk-weighted assets, we have to keep a certain amount of capital. What are the components of capital? Now, one is called the tier 1. Another name for tier 1 is core capital. In your exams, promotion, CAIIB, often asked what is another name for tier 1 capital. It is called the core capital. Now, as per Basel III, it's further subdivided into two. What is it? Common equity tier 1 capital and additional tier 1 capital. So if you want to just understand, without going into the basic as a layman, tier 1 is something of pure capital, which has pure equity characteristics. जो सबसे अच्छा साफ सुथरा capital है, highest maximum loss absorption capacity. So equity plus all your disclosed reserves which are there in the balance sheet, that's your equity tier 1 capital, right? On the other hand, we have tier 2 capital. Another word is supplementary capital. It will have some kind of reserves and subordinated debt. So certain debt or hybrid debt, which has some equity and debt characteristics, they may be included in tier 2. But again, it's not something called pure capital, right? Another word which Basel has said is, or RBI says is, tier 1 is called the going concern capital. It absorbs losses without triggering bankruptcy. Tier 2 capital is called the gone concern because only in terms of liquidation this will be helpful. So we should try to maintain as much as possible tier 1 capital. So that is much more secure capital, right? Now, when we talk about tier 1, what are the components? So common equity tier 1 and additional tier 1. Now, there could be some confusion here. I know it's quite a bit of information, but just to understand, all your capital plus all your reserves. And of course, there's something called revaluation reserves, which is earlier part of tier 2, has now been brought under tier 1. Any kind of capital reserves. So reserves and capital is your tier 1, minus any investments the company has made in subsidiary, bank has made in subsidiary, any intangible assets, right? Any kind of losses that is subtracted, you get your tier 1 capital. What is additional tier 1? So you have non-cumulative preference shares, which are perpetual in nature. Perpetual means they don't have a fixed maturity period, right? So these are there are some things which are defined as innovative perpetual debt instruments. Now RBI has defined all of this, right? So we'll not get too much into this, but RBI has specifically defined what will come under perpetual innovative perpetual debt instruments, and only that is allowed or as eligible capital will be considered by the banks to calculate the capital adequacy ratio, right? What is tier 2 capital? Any undisclosed reserves. So some reserves, which are secret reserves, which are not shown in the balance sheet, they may be considered, but then again, we don't know about. So that's up to the bank. Loss reserves, NPA reserves, hybrid debt instruments, any debt which is more than 5 years maturity, investment reserve account. So that is your tier 2 capital. You'll have, now here it was perpetual non-cumulative preference shares. We have perpetual cumulative preference shares here. Redeemable preference shares, non-cumulative. Redeemable cumulative preference shares. Any share premium from issue of these above shares will be part of your tier 2 capital, right? So broadly speaking, this is your pure capital, pure equity. This is some kind of debt characteristics which come into play. What is important from exam point of view is revaluation reserve is now a part of tier 1 at a discount of 55%. So if it's 100 crores revaluation reserve, you add only 45 crores for the purpose of calculating capital adequacy ratio. Your tier 2 capital cannot exceed tier 1. Very, 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 very important from exam point of view, right? There is a reason behind it, because tier 2 isn't that good. So you shouldn't have entire capital made up of tier 2, right? Your general provisions and loss reserves can be maximum 1.25% of your risk-weighted assets. Same thing with investment reserves, right? Now, as per RBI, again, this is very, 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 very important, which is asked. Total capital adequacy ratio, which you have to maintain, is 9% of your risk-weighted assets, right? So my capital upon my risk-weighted assets should be 9%. Now, 7% should be my tier 1, 2% should be my tier 2. This should be maximum 2%. It is possible that my 9% is made up entirely of tier 1. No issues. RBI has no problem if tier 1 is 9%, tier 2 is 0. But it shouldn't be the other way around. It shouldn't be tier 2 being 9% and tier 1 being 0%. No. Tier 2 capital 1 cannot exceed my tier 1 and it cannot exceed 2%. Why? Because obviously I want most of my capital adequacy should be made up of my good capital, which is my pure capital, which has a higher loss absorption capacity. Within tier 1, my common equity tier 1 should be 5.5%. Additional tier 1 should be 1.5% minimum. This is my minimum capital. The RBI says, I'm saying 9%, does not mean you maintain 9%. This is the minimum. If you are capable, maintain 17% as RBL has maintained. Maintain 20%. That's up to you. Because you may perceive that there may be more risks which RBI probably is, or you may not, which you cannot fathom. Not all risks are known to you. There are some unknown risks. Something like COVID taught us. Nobody expected COVID to happen, right? So it's not, this is the minimum that I have prescribed. I'll tell you why minimum was also prescribed when we talk about Basel. But this is the minimum I have prescribed. You can maintain and you should maintain more than it if if your assets or capability allows you based on your own risk management. Now, recently, RBI said that beyond 9%, you have to maintain 2.5% of capital conservation buffer. We'll discuss what is CCB. So plus 9% plus 2.5, banks have to maintain 11.5%. This capital conservation buffer is only part of common equity tier 1 capital. So this should be plus 2.5%. So tier 1 capital should be 9.5% minimum. Tier 2 remains the same because tier 2 is not impacted. My capital conservation buffer, some buffer that I have to keep aside from my common equity tier 1. And because common equity tier 1 is part of my tier 1 capital, so only my tier 1 gets impacted. At present, this last tranche tha common equity tier 1 of of capital conservation buffer. This is yet to be implemented, 0.0625%. This was deferred till October 21. There's no update by RBI in this regard. So if I have to say, instead of 11.5, today banks have to maintain something called 10.875%, including capital conservation buffer. How much? 1.875%. 2.5 karna if there will be full implementation. Pending full implementation, if I exclude capital conservation buffer, my capital adequacy ratio is my 9%. If I include capital conservation buffer, it is 10.875%. After full implementation, this will be 11.5%, right? So this is very, very, very important. Again, minimum tier 1 capital is 5.5%, right? Total, if you see, is 9%, excluding capital conservation buffer. Including capital conservation buffer, you have to total capital ratio that you have to maintain, minimum total capital ratio, 11.5%, right? 2% is your tier 2, 7% is your tier 1, right? So if you see, your capital conservation buffer is only comprising of common equity, right? This is often asked in your promotion exams. Now, I hope till now it's clear. Then we move to something called Basel Accords.
Yes, ma'am.
Yeah. So Basel क्या है? ये खूबसूरत सी जगह है Basel. So Basel is basically a place. We play name, place, animal thing. It's a place where in Switzerland.
Gulati, can I add something, Gulati?
Yeah, yes, sir. Yes, sir. Yes, sir. 1 second. Yeah, friends. Friends, that we have pleasure that we have with us Mr. Mohan Tangsale, former CEO of Indian Banks Association and former chairman cum managing director from Central Bank of India. I welcome you, sir, over here. And friends, Mr. Tangsale is presently joining us from USA. So it is our privilege that today we have with us Mr. Mohan Tangsale, and sir is mentor with us Banking Quest. I welcome you, sir. Kindly, sir.
Thank you. Thank you, Sonali. You have done a great job. My compliment to you and compliment to Gulati for conducting such programs for the bankers. On the capital, I would just like to add one very important aspect for the benefit of operational bankers. The capital built up is essentially coming from retention of profits. And this is what you as a banker, whether you're a branch manager, whether you're an officer, whatever level you are, you must understand that the profit retention gets added to my capital as a reserves, and that is the most important part. And thus, when I look at the health of the bank, I do not look at only the capital adequacy, but I also look at the ROA, that is return on assets. And typically, if I do not have the return of asset 1 plus, let me tell you, I am really not justifying my operations. And so Sonali, in your coverage, if you can maybe giving little thrust to the internal generation of the capital, it is retained profit. Because my thrust to the bankers is that while I can raise the capital from outside, because the moment you talk of capital, equity, bonds and all that, it all comes from the investor world. But the real gold mine is my retained profits. Am I right? You will agree with me, Sonali?
Yes, sir.
And thus that little importance I would like guys to understand. And if they are preparing for the CAIIB or internal promotion exams, I will say that give a thrust on that and articulate it properly. And towards that, I used to always say that each branch manager is a CEO by himself. If as a CMD of central bank, I had to care for the proper composition of the liabilities and the assets to see that my profits are good, each branch has to also take a lot of, give the importance to the composition of the assets and liabilities and make sure that they are generating the optimal profits, if not the maximum profit. I think this is what I would like to add. I was excited when I was listening to Sonali. Well done. I am very proud that you are imparting good knowledge to my bank colleagues. So, Gulati, with your permission, can I exit now?
Yeah, thank you so much, sir, for your guidance. Your mentorship keeps us encouraged, sir.
All the
Really.
best, all the best, all the best,
Thank you,
all the
sir.
best. Thank you. Thank you.
Yeah, Sonali, over to you, please. Thank you.
So I think that's very, very important input that we get from senior bankers, and I think our honor that we have somebody so senior with us. So just to continue, yes. So Basel is a place in Switzerland, and from there we now talk about this Basel Accords. I'm sure everybody knows it. For the benefit of those who do not know, we're going to discuss about this. So there was this Bank of International Settlement, BIS, which was set up in 1974. The very oldest bank there. 1974, it was set up in Basel, Switzerland. So Basel being a place in Switzerland. This Bank of International Settlement, they set up a committee called BCBS. Again, the full form is very, very important. Basel Committee on Banking Supervision. And this Basel Committee was made up of 45 members from 28 countries, including the Reserve Bank of India. So all your accords, all these accords, 1, 2, 3, even 4, Basel 4 has also come in, that's yet to be implemented and published. So all these accords actually came from BCBS. Now, the decisions have no legal force. So it relies on the members for implementation of the norms. So for G10 countries, they're still binding, but for something like RBI, there's no legal binding that we have to go by Basel norms. But because RBI is a member of this committee, that is why it's kind of, obviously thrusted upon the members that they're supposed to comply with it. So we have something called Basel I norms. They came up in the year 1988. So 1974, BIS was set up. BIS, which was the bank, which was the oldest bank, and there was this BCBS committee. In 1988, we had the first Basel norms. And for the first time, they spoke about the minimum capital requirement. Two objectives. One was to promote the financial soundness of the banking system, right? The second, to encourage healthy competition. Now, what was happening was that there was no fair play for amongst all the banks. So let's say it was not that there were no ratios, there was no requirement there, but every country had a separate rule, a separate capital adequacy. And the way they used to calculate it was also different for every country. So let us say some bank in Europe thought the capital adequacy for every 100 crores of asset, you need to keep 9 rupees of, or 9 crores of, for 100 rupees of assets, you need to give 9 rupees of capital. Whereas there may be some bank in US, for every 100 rupee of asset, I need to keep, let's say, only 4 rupees of capital. Some bank in India, I'm just taking hypothetical situation, 100 rupee of asset, I need to keep 20 rupees of capital. Now, is it a level playing field? No. Why? Because for 9 rupees of capital, here I'm keeping aside a lot of capital. So obviously the money that is available for me to lend reduces, right? On the other hand, I'm keeping 20 rupees as capital. So the money available to lend here is much lesser than somebody who's keeping just 9 rupees, right? Let us assume here, for example, so here 100 rupees was my total balance sheet size. 9 rupees if I keep as capital. So the amount that is available to lend reduces to 91. If against this 100 rupees is my balance sheet, and let's say my capital is 4 rupees, so the amount available to lend would be only what? So here 96 rupees. So here, somebody who's having 9 will have 91 rupees to lend, whereas somebody who's having 4 will have 96 to lend. On the other hand, somebody who's keeping 20, like in India, somebody, let's say, kept 20 rupees, could only lend 80. So it was not a level playing field. And the reason why Basel Accords came into place was because they wanted to have something called healthy competition. So nobody could build up assets based on low capital base. So you can't be aggressive by 4 rupees of capital, you keep lending. You have to ensure that there has to be certain minimum capital available. Yeah. So when we talk about Basel I Accord, so in 1988, Basel Committee on Banking Supervision, BCBS, published the first set of minimum capital requirements, and these requirements came to be known as your Basel Accord or Basel I. What was the objective? Only two: to ensure the adequate level of capital and that therefore the financial soundness of the international banking system. Now we're talking from a international point of view. So it's not about country. Why? Because we spoke about something called financial interdependence. We spoke about systemic risk. So there was this bank, 35-year-old German bank called Herstatt Bank in Germany, which failed. Because that bank failed and it had open forex positions with various banks outside, banks in US failed. So it was realized that, international banking system, there has to be some commonality and there has to be some common rules and regulations, some guidelines. So to ensure the adequate level of capital in the international banking system, to strengthen the competitive market under which banks could no longer build adequate business volumes without adequate capital backing. So it's not with 4 rupees of capital you start giving out loans. No, you have to ensure some adequate capital backing. Only then you build up your business volumes. Basel I exclusively focused on credit risk. In 1996, there was an amendment which included the market risk, but initially there was only spoke about credit risk. That is what they understood. Now, banks' assets were assigned various buckets. So there were few buckets. For example, cash was 0% risk weight. So development bank debt was 20%. Residential housing mortgage was 50%. And private, let's say Ambani or any other corporate that you lend, it was 100%. So what they did was that even earlier, there was some kind of debt equity ratios or there was some kind of capital ratios. But this time what happened was that there were some buckets that were identified. Now, for example, let us say I have 100 crores of loans and advances. 50 rupees I keep as cash and 50 rupees I give a loan to ABC Limited. Now, prior to Basel, what happened? On this 100 rupees, my country decided that minimum capital adequacy ratio is, let's say, 9%. So on this 100 rupees, I keep aside how much capital? 9 rupees, right? Now, what Basel I said that no, you need to bucket these assets based on their riskiness, right? So if I have 50 rupees cash and 50 rupees loan to ABC Limited, it's not the same risk level. Cash is no risk. So why should I keep capital for cash? So I'll keep zero against this 50 rupees. But for this 50 rupees which I've lent to ABC Limited, I will assume how much risk weight? 100% risk weight. So I will keep 50 rupees. So now my risk weight assets, my total assets are still 100 rupees. My risk weight assets are 50 rupees. Now, if I were to keep 9%, I will keep how much? 4.5 rupees as capital. Whereas prior to Basel I, on this 100 rupees of assets, I had to keep 9%, 9 rupees as risk weighted assets. 9 rupees as capital. Is it clear? Pre-Basel and post-Basel, there were some ratios then also, but assets were not classified based on the riskiness and risk weightages were not assigned. So banks had to assign capital. Now, it's not necessary that it lowered the capital requirement of the banks, right? Because if there were some banks which had entirely risky assets, the capital requirement remained the same. So now banks were motivated to have mix of assets, some less risky assets also. So I'll keep 20% as developed debt. development bank debt, I'll keep some residential mortgages. So after Basel introduction, I could keep less capital if I had good quality assets, right? So this was the incentive which was given, that get better quality of assets and your capital requirement is lower. Lower the capital requirement means you can lend more, right? Now, banks were required to hold minimum capital of 8% of your risk weighted asset. This 8% came up in Basel I, friends. It has remained the same till date. So this is one thing which has remained the same. And India prescribed, or RBI prescribed it as 9%. So internationally it was 8%. RBI, being a little more conservative, prescribed it at 9%. Off balance sheet items were also included. They were converted into credit equivalent. There was a credit conversion factor, and they were also factored in. Initially, we only spoke about the on balance sheet, but after certain amendment to Basel I, off balance sheet items were also included, right? What was Basel II? So Basel I aa gaya, right? Capital requirement set ho gaya, but banks still failed. So we had the famous 2007-8 global financial crisis. There were still substantial losses in the international market. So what was going wrong? So what happened was, this BCBS committee of so many members sat down again and thought, what is wrong? So they came up with a refined and a reformed version of Basel I. And this came in 2004 actually. A comprehensive version was issued in 2006. This came to be known as Basel II. Basel II में क्या किया? So minimum capital adequacy ratio remained the same. That is still the same. That was your pillar 1. 2 new pillars were added. Which two? Pillar 2 and pillar 3. ठीक है? Pillar 1 only spoke about, in Basel I, we spoke about credit risk and market risk. Now, for the first time in Basel II, they spoke about operational risk. Pehli baar this understood that there's something called operational risk. Number 1, capital adequacy remained the same. So total risk-weighted assets were capital kept aside for credit risk plus capital for market risk. New thing that was there was capital set aside for operational risk. So in India, risk-weighted capital adequacy ratio was 9%. So risk-weighted assets would be how much? So if you can get it in exam, so your capital adequacy ratio is 9%, right? So if I have to calculate risk-weighted assets, so how much will be my risk-weighted? 100 upon 9. You multiply your capital multiplied by 11.11%. So risk-weighted assets was capital charge for credit, market, and operational risk, right? And what was important here, we spoke about pillar 2 and pillar 3. So 3 pillars were there. Second pillar was regulatory supervision, which means the RBI, who's a supervisor, has to step in and has to supervise the working of the banks. A third pillar was market discipline. Market discipline means banks are dealing with public money, so they need to have more disclosures. जो एक public sector bank, public sector company करती है, listed company करती है, banks need to disclose more. So today, if you open a website of any bank, you'll have a separate Basel III disclosures. The kind of information that banks are giving out today is much higher. Now, Basel II had 3 pillars. And these 3 pillars have continued in Basel III as well, right? So these are the pillars. You can get the names of the pillars. Okay. This was already there in Basel I. There was no change here. What new came was Basel pillar 2, pillar 3, and operational risk in pillar 1. So it now spoke about minimum capital requirements, number 1. It also spoke about a supervisory review process. So RBI needs to come into place and review it and give a constructive feedback. And pillar 3 is market discipline, which speaks about more granular information, more disclosures that banks need to do. So you have stakeholders, you have shareholders, you have public, you have customers, you have employees. Everybody should know what's going in a bank, right? Now, Basel III has come up with effect from April 2013. What is the change here? So now there was some, before I just let me tell you that in pillar 1, or there was some kind of shortcomings which were there in Basel I, which were removed in Basel II. So in Basel I, there were some 4 buckets only. So if you're giving loan to an Ambani and if you're giving loan to a Panwala, all of them came into that fourth category, 100% risk weight. In Basel II, this shortcoming was actually removed, overcome. How? So you had risk weightages based on your credit ratings. So a AAA had a different risk weightage, whereas a BBB had a different risk weightage. We'll come to what these risk weightages are, but these were the shortcomings of Basel I, which were partially removed by Basel II. So there was a differentiation even if you are lending to a corporate customer, an Ambani or a small SME customer. A AAA and a AA cannot have this, AAA and a BBB or a BB cannot have the same risk weight, right? So this was an incentive to have more granularity as far as asset quality was concerned. Now, coming to Basel III. So Basel III, again, in terms of capital adequacy ratio, no change. This has remained since Basel I. What is new? One, the capital. Now, till Basel II, we had tier 1 capital and tier 2 capital, right? Now, in Basel III, they spoke about common equity tier 1 and additional tier 1. So, new thing that came up was common equity tier 1 capital and additional tier 1 capital. So, they did more segregation of tier 1 capital to bring it more transparent, right? Plus, there was a tier 3 capital which was introduced in Basel II, which is no longer there. So I have not discussed that, just in case for your information. Tier 3 capital was there in Basel II, which is no longer there. It has been abolished, right? Now, pillars remain the same. So pillar 1, pillar 2, pillar 3 is still the same. The names of the pillar are just the same. What has happened is they have been broadened, right? So some new things have been added to the same set of pillars. They have introduced the concept of capital buffer. They said, like, we keep our savings na gullak mein, we keep some savings na piggy bank. So they said, okay, when there are normal times, you keep aside some buffer. That will be called capital conservation buffer. Over and above your capital adequacy ratio, you keep aside some money. And this money, don't use it during normal times. Use it only for stressed times. Then they said, okay, keep not 1, but keep 2 buffers. How many? 2. So there's something called counter-cyclical capital buffer. Counter-cyclical capital buffer. This will be also, let's say, normal time mein you keep aside some money, that is capital conservation buffer. When you have exponential growth, bahut acha time chal raha hai, your bank is growing like in leaps and bounds, keep more money aside for the rainy day. So you have one capital conservation buffer. Now you also have something called counter-cyclical capital buffer. So 2 buffers were introduced as far as Basel III was concerned, right? So 2 buffers were introduced. This was a new thing that was introduced. Next, liquidity. Till now, banks still failed. Now, why Basel III came? Banks were still failing. Banks said that our capital adequacy ratio is there, yet there is a bank failure. Means whatever assets that are there in my balance sheet, have you thought whether, okay, for these many assets, I need to keep 9 rupee capital. Very good. But have you thought that these assets are liquid or not? Can I sell them off timely and I can pay off my liabilities? Are they liquid or are they illiquid? Nobody spoke about liquidity. So a new ratio was introduced, liquidity coverage ratio and net stable funding ratio. One is short term, the other is long term. These were the liquidity ratios that were introduced for the first time in Basel III. So new thing is buffers, new thing is your liquidity ratios, new thing is your tier 1, tier 2 further bifurcation. Another new thing is leverage. एक तो हो गया risk based leverage. Your capital adequacy ratio is nothing but a kind of leverage ratio only. How much assets I need to keep, how much capital. And these assets are based on my risk weight. They said, okay, forget risk weight. If I actually am a little not so discreet banker and I actually underplay my riskiness, there has to be something called leverage, overall leverage. So total assets, how much capital I need, tier 1 capital I need to keep, that is my leverage. So this was not based on the riskiness, so that banks don't undermine their risk, right? So this was a risk free based measure कि ठीक है एक हमारा risk based measure है in terms of capital adequacy ratio, but other than that there should also be a leverage ratio. So we have Basel III ratios here, if you can see. So 8% remains the same total capital ratio. So you have a capital conservation ratio of 2.5%, counter cyclical conservation buffer 0 to 2.5%. So to summarize, Basel III separation of capital adequacy ratio was done in common equity tier 1 total capital, right? In India, banks have implemented Basel III norms, except that last tranche, which I already discussed. Now, extended to all India financial institutions also, these Basel norms, the timeline is April 2022. Again, we have pillar 1 remaining the same for credit risk, market risk, operational risk. We need to keep aside some capital. There's a change in how it is done for operational risk, right? I'm not going to deep dive into this. This is the kind of capital adequacy computation by a public sector bank. So if you can see here, capital requirement for credit risk is given. How it is calculated, there's a standardized approach there. Capital requirement for market risk is given. There is a duration approach there. Capital requirement for operational risk is there. There's a basic indicator approach there, right? So you have a total capital requirement of these many millions. You have tier 1, total capital fund is already given. So you have a tier 1 ratio, tier 2 ratio. Total capital adequacy ratio is 15.47%. This is how banks actually disclose and calculate your capital adequacy ratio, right? So pillar 2 spoke about again the supervisory review, right? And prompt corrective action was a part of this supervisory review. So there has to be some kind of assessment that RBI needs to do on an ongoing basis. Pillar 3 spoke about more disclosure requirements, supplementary and core disclosures, and this was complementing pillar 1 and pillar 2. These disclosures are required to be made at least twice in a year. So now coming to the few things that have been introduced, capital conservation buffer. एक buffer रखना है. What is it? It is a built up of a buffer during what time? जब ठीक ठाक चल रहा है, normal time, outside the period of stress. Why? To avoid any breaches in my capital adequacy ratio. But when it can be used only when you face a systemic risk or an idiosyncratic risk. What is idiosyncratic stress? Which is specific to a particular bank. For example, a yes bank faces specific stress. You can use that buffer. Or when there's an entire market failure that is happening that impacts you, systemic risk. Banks should not choose in normal times to operate in this buffer range. And this will be specifically looked into by the Reserve Bank of India during its SREP. Pillar 2, supervisory review and evaluation process. This is what RBI will do. It will check whether you are keeping that buffer 1, and if you are have you utilized it during the normal times. How much it has to be maintained? 2.5%, right? This last tranche is been extended till October 2021. And if you don't keep it, you have some kind of constraints or restrictions which will be imposed. There's something called counter cyclical buffer. Now, this has not been implemented by RBI. So RBI has kept it as 0. This is a second kind of buffer. Again, it's an extension of your first buffer. When during economic expansions, when it is too high growth ratio, then you keep a 0 to 2.5% of your risk-weighted asset, additional counter-cyclical capital buffer. And both these buffers only are to be kept with respect to your common equity tier 1 capital. Doesn't impact your tier 2 capital, right? Now, liquidity, as I said, so banks were still failing. We didn't check whether the assets which were there, especially the global financial crisis, we had mortgage-backed securities, whether we could sell them or not. So housing bubble happened, the prices fell down, you could not sell those assets, and then suddenly you face a crisis situation. So they said we need to look at liquidity. Nobody speaks about liquidity. So in the short term, we have a liquidity coverage ratio. It's a short-term liquidity measure. How is it measured? It's the ratio of your HQLA, which is high quality liquid assets, divided by your net cash outflow for 30 days. Basically, it says next 30 days, RBI says it's only focusing on 30 days. अगर 30 days आप liquidity meet कर लेते हैं, then you need not worry about the next. This is your immediate concern. If you're not able to meet your 30 days also, you are in a big problem. So calculate what are your inflows for your 30 days, calculate what are your outflows for the next 30 days, find out your net cash outflow for the next 30 days. Now these are my अगले 30 दिन के लिए मेरे expenses है, मेरा खर्चा है. I need to ensure that I have a stock of assets which are liquid to cover up that. So how much should be the coverage? It should be 100%. So this is all what is your liquidity coverage ratio. It was prescribed at minimum 100%. At any given point of time, I should have at least, for every 1 rupee of my outflow which is there, I should have 1 rupee of liquid asset, and this was clearly defined. So there's a level 1 here and level 2 here. I'm not going into that. Based on the liquidity characteristics, this HQLA, those assets which could be immediately converted into cash were defined and they were eligible by RBI. So COVID-19 ke chalte, because of COVID-19, the ratio was earlier stipulated as 100%. Because of this has been brought down to 80% today. And if you remember in RBL, we saw it was 135%, right? The second is a net stable funding ratio. This is on the long-term aspects. Now, because of COVID, RBI has deferred the implementation of NSFR. So you only see in all the reports LCR, not NSFR, because this implementation has been deferred. What is this? This is your available stable funding divided by your required stable funding ratio. What is available stable funding? In my balance sheet, my capital plus my liabilities. What is stable? My capital and those deposits which are stable. What is my requirement? What assets I need to pay off? So my available stable funding divided by my required stable funding should be greater than 100%. But this ratio is yet to be implemented by RBI. Last is your leverage ratio. As I said, what is the difference between leverage and tier 1 capital adequacy ratio? Leverage ratio is also your tier 1 capital upon your assets, total consolidated assets. Any difference between tier 1 capital ratio and this? Yes. Only the denominator. There is no risk weight here. There's all assets here, irrespective of risk base. So they said that, if you're underplaying your risk up, you are just showing it's not a it's probably a triple B asset, but you're showing it as a double A. Some banks can do that. So this is a non-risk based backstop. It's a backstop arrangement, something to fall back upon, so that banks don't build up, excessive leverage to avoid destabilizing in the broader financial system. You cannot have any kind of damage there. So this is supplementing your capital adequacy ratio. And this was kept as 3%. But for domestic systemically important banks, which is your HDFC, ICICI, and your SBI, this is kept as 4%. So 3% is what Basel has kept. RBI has kept it as 3.5%. For domestically systemically important banks, it is 4%. That your leverage cannot exceed this much. So leverage has to be minimum this much, right? Because it is capital upon your assets, right? So you must keep this much capital, right? So these guidelines again are effective from October 2019. So this is the guideline Basel implementation timeline. It has gone through various iterations. We had Basel I in 88. Only in 2004, we came up with 88 to 2004, so long it took to come out with Basel II. We had Basel III in 2010, and now we had been the timeline has been extended due to COVID. Basel III has been implemented in India, but last tranche is yet to be implemented. So October 21 was the guideline. I hope everyone is clear till here. So a short information now. So if we can move on, last, a very small aspect which is left is your credit ratings, because we're talking about credit risk and credit risk measurement. So just let me deep dive into this. So credit ratings, how we should calculate it. It could be internal, it could be external. So most banks use the standardized approach as per Basel, which is based on the external rating, right? But you can use the internal rating based approach or IRBA also. But of course, most banks again use the standardized approach. Now, credit rating can be borrower wise, can be facility wise, like you have cash credit term loan, or it can be a country rating. For example, India has a triple B minus rating, which is the lowest investment grade rating that we have. Now, external credit rating, RBI has accredited only 6 domestic credit rating agencies that can give this rating. For NBFCs, we have Informix, but otherwise we have SMERA, which is now acute. Brickworks, which my license was supposed to be revoked. I don't know what's the status now. CAIIB, CRISIL, and ICRA, right? So these are the only external rating agencies which are there. And only through this, if you do not get them rated through these 6, then your risk weight, which will be as per your unrated exposure. It will be considered as unrated exposure. So if you look at the risk weightage for corporates, so we have the long-term ratings, the short-term ratings. Now that is clearly divided. So those up to 1 year are short-term, but those more than 1 year long-term. Cash credit is considered under long-term by the rating agencies, right? It's not considered short-term. So we have AAA to D rating. D is your default rating. Short-term, we have these kind of connotations. Now, so we have investment grade from AAA to triple B. Now here, Basel I did not, all of them were rated 100%. Now, if you see 20%, 30%, 50%, 100%. So depending upon better the rating, the lesser the capital you need to keep. It's not like corporates, you can't keep 0%. It has to be minimum 20% at least, even if it is AAA. Below triple B, it comes to speculative grade, right? Junk grade. So that is 150%. Up to default. If it is an unrated exposure, it is considered as 100%. So this is, friends, what is there as far as the credit ratings risk weightages are concerned under the standardized approach. Yeah. So with this, thank you so much.